This is the chart that should terrify every single American holding a dollar. For 30 years, the US dollar reigned supreme, backed by the implicit promise of the US Treasury bond. Buying T-bills was the safest trade in the world. Buying gold was for fringe fanatics. That era is over. It just ended. Look closely. Right here, the unthinkable happened. Central banks just chose gold over the US dollar. They are now buying and holding more physical gold than they are US Treasury debt. This isn't a market shift you read about in the Wall Street Journal. This is a geopolitical collapse signal. And that's not the scary part. The real secret is who is buying, where they're hiding it, and the terrifying historical precedent they are using to justify the greatest wealth confiscation since 1933. Let's be precise. The flip happened in Q3 of last year. The net purchases of physical gold by global central banks exceeded the net purchases of US Treasury securities. Why does this matter? Because Treasury bonds are the bedrock of the US financial system. They are the mechanism that backs the dollar. When the world's most powerful financial institutions decide that a physical asset, an asset that pays zero interest, is a safer bet than the US government's debt, you have a crisis of confidence. For decades, the T-bill served three functions: a store of value, a global reserve asset, and the safest collateral. Gold only serves one: a store of value. But the store of value is winning. Why? Before we dive into the dark truth of why this is happening, if this kind of hidden financial pattern recognition is vital to your survival, hit that subscribe button right now. You won't find this analysis anywhere else. The reason central banks don't trust the dollar starts with a lie hidden in plain sight: the $42.22 gold trick. The United States officially values its 8,133 tons of gold reserves at $42.22 per ounce. That's the statutory price set in 1973. It has never been changed. At that official price, the U.S. government's gold is worth only $11 billion. But at the current market price, roughly 2,700 Oz, that gold is worth over $750 billion. That is a hidden value gap of almost $700 billion sitting on the Treasury's books. It's a deliberate accounting mechanism. Why? Because the government needs the ability to revalue gold at any moment. You think that's just a dusty old law? They've used this exact mechanism before. In 1933, President Roosevelt signed Executive Order 61002. Americans were forced to turn in their gold for $20.67 per ounce. 9 months later, the government revalued that same gold to $35 per ounce. Overnight, they created billions in paper wealth and devalued the dollar by 40%. The ultimate goal: to erase their debt burden. That 1933 playbook is back. The fear among global central banks is that the U.S. will pull this trick again to make its $37 trillion debt sustainable. And this time, the target isn't 35 Oz, it's $20,000 Oz. So, who are the buyers making this gold flip happen? It's not your average retail investor. It is the BRICS alliance, led by China and Russia. China, in particular, has been accumulating massive amounts of physical gold for 17 straight months. This isn't about profit. This is a strategic, political move aimed at creating an alternative to the U.S.-dominated financial system. Their goal is to shift global trade, especially oil and commodities, away from the U.S. dollar. They call it De-Dollarization. But what do they replace it with? They need a neutral, non-fiat asset. They need gold. But here's the twist. The BRICS nations might secretly be hoping the U.S. implements the 20,000 Oz plan. Why? Because if the U.S., the world's largest official gold holder, says gold is worth $20,000, that becomes the global floor price. It instantly legitimizes the trillions of dollars worth of gold reserves held by China and Russia, allowing them to reduce their own debt burdens and legitimize their own currencies. It's a game of synchronized wealth creation. What does the 20,000 Oz revaluation actually mean for you? It's not about making gold holders rich. It's about making the dollar worthless. If gold goes from $2,700 to $20,000, the dollar has lost 86% of its purchasing power relative to gold. This is where the wealth transfer happens. Winners. The U.S. government wipes out 30T in real debt. Early gold holders, if held outside U.S. jurisdiction, and foreign governments whose reserves instantly balloon. Losers. Anyone holding cash or U.S. bonds. Retirees on fixed income, the middle class whose wages cannot keep up with the 25–30% annual inflation. The government knows this is unpopular. They will not announce an outright confiscation. They will use the soft confiscation playbook. They are already building the legal framework for it. The question isn't if the dollar is being debased, but how you protect yourself from it. The plan is already in motion. The timeline is 2025 to 2028. This brings us to the ultimate hedge. You need assets that cannot be controlled, tracked, or debased by any single government. Physical gold, silver. Outside U.S. jurisdiction, get allocated storage in vaults in Switzerland or Singapore. The key word is allocated. You own specific bars, not pooled or certificates. Self-custody Bitcoin. Hold your Bitcoin off exchange in a hardware wallet you control, self-custody. This is a decentralized asset immune to government executive orders. Productive real estate tower, farmland. Buy assets that generate cash flow and are vital for human survival, food, shelter. They are the ultimate inflation hedge. This is not a theory. This is pattern recognition. The 1933 playbook is repeating. The language in the recent executive orders is identical. You have 2 to 3 years to position yourself outside the confiscation zone. Don't wait until the news headlines hit. By then, the vaults will be full, and it will be too late for good execution. You're either protected or you are destroyed. The choice is yours.